Hello traders, and welcome back to the channel. In today's chapter of our course, Technical Analysis for Day Traders, from Basics to Advanced, Basic Candlestick Patterns. Learning to read them is crucial for gaining an edge, since they often mark key turning points driven by market sentiment and institutional activity. In this lesson, we'll walk through the essentials, how a candle forms, and what its body and wicks reveal about price action. From there, we'll move to the most common single candle patterns, bullish and bearish pin bars, the different types of doji, the hammer, and the Marubozu, each one a clue to potential reversals and continuations. So what exactly are candlesticks? They're one of the most popular tools traders use to visualize price movement. Each one offers a detailed snapshot of market sentiment over a specific period and is essential for spotting patterns and trade opportunities. By examining a candle's shape and size, you can gain insight into the ongoing battle between buyers and sellers, momentum, and potential reversals. Each candle represents the asset's price movement over a period. On a daily chart, one full day of price action. Candles simplify analysis by giving a clear visual picture of market behavior during that time. So what does a candlestick actually look like? It has two main parts, the body and the wicks, or shadows. These components are critical for reading price action. The body represents the range between the open and the close, while the wicks show how high and low price moved during that time. On the chart, you'll typically see two types of candles, green or bullish and red or bearish. A green candle forms when price closes higher than it opened, showing that buyers outpaced sellers. Likewise, a red candle forms when price closes lower than it opened, showing that sellers dominated the session. So why are candlesticks so important? They give traders a more nuanced read on price movement, with each candle offering a complete snapshot of sentiment for that period. The upper wick shows the highest price reached, while the lower wick reflects the lowest. The body size and position reveal which side was in control. Before the specific patterns, let's cover two key concepts that help you read candles. First, big versus small body. The size of a candle's body is a strong indicator of market strength. A larger body means one side, either buyers or sellers, dominated the session, while a smaller body reflects indecision or a balance between the two. Let's look at two examples of green candles. In the first, the body is large and the wicks are small, suggesting buyers were firmly in control. Price opened lower, sellers tried to push it down, but buyers quickly stepped in and drove it higher, closing near the session's high, a clear sign of strong buying momentum. The second candle tells a different story. Here buyers still pushed price higher, but sellers stepped in at the peak and drove it back down. Even though it closed above the open, the smaller body shows a closer contest between buyers and sellers. Next, let's talk about large wicks. Wicks, or shadows, are just as important as the body. They reveal price rejection, when the market tries to move one way but ultimately reverses. A long upper wick, for example, shows that buyers tried to push higher, but sellers overpowered them, creating resistance. Likewise, a long lower wick shows that sellers pushed price down, but buyers stepped in and drove it back up, signaling support. Wicks often act as early warning signs of a reversal. A long wick above the body can mean price is running into resistance, making it hard for buyers to push higher. A long wick below the body suggests buyers are stepping in to keep price from falling further. Now that we've covered the basic structure of a candle, let's see how these elements combine to form specific patterns. Candlestick patterns are the foundation of candlestick charting, helping traders identify key turning points in the market. Mastering them sharpens your ability to spot high-probability setups with confidence. But first, something fundamental. While single candle patterns can be powerful for identifying reversals or continuations, relying on them alone without considering the broader market context can lead to costly mistakes. Every candlestick tells only part of the story. A single candle on a higher time frame is often made up of many candles on a lower time frame, each revealing additional information about buying pressure, selling pressure, liquidity, and market intent. Looking beyond the individual candle, helps traders understand what is really happening beneath the surface. Equally important is where a candlestick forms within the overall market structure. A pattern appearing near a major support or resistance level, inside a supply or demand zone, or after a clear market structure shift carries far more significance than the same pattern forming randomly in the middle of a trend or trading range. Context transforms a simple candlestick pattern into a meaningful trading signal, helping you distinguish between potential reversals, continuations, and false setups with far greater confidence. Now look at the bullish 60-minute candle on your screen. It looks extremely strong, a clear move up, opening at the low and closing at the high, with no visible resistance. But by breaking that 60-minute candle into 4 consecutive 15-minute candles, you gain deeper insight into the price action that unfolded during the hour. Let's consider 2 scenarios. In scenario 1, we have consistency. On the left of the screen, 4 consecutive 15-minute candles are all similar in size, showing a steady uptrend. This tells us the bullish momentum held throughout the full 60 minutes, with no significant interruptions or reversals. Here, the strength of the 60-minute candle is confirmed by the continuous buying pressure in the shorter time frame. In scenario 2, we see mixed signals. On the right, the same 60-minute candle forms differently. The first 15-minute candle is strongly bullish, similar in size to the hourly one. But the next 2 candles are bearish, retracing most of the initial gains and pulling price back to the opening level. Finally, the fourth 15-minute candle matches the first, driving price back up to the high. Overall, the 60-minute candle looks bullish, yet the lower time frame reveals volatility and selling pressure in the middle of the hour. This mixed behavior suggests the market wasn't as decisively bullish as it appeared, hinting at pullbacks or resistance that could cause false breakouts or early exits. Both scenarios show why multiple timeframes matter. The 60-minute candle may look strong, but the 15-minute candles reveal much more. In the first scenario, the consistent bullish candles confirm the move's strength. In the second, the mid-session retracement, hidden inside the 60-minute candle, shows a period of indecision, even resistance, before buyers regained control. Examining both higher and lower timeframes helps you read sentiment and avoid trading on a single candle's appearance. This multi-time frame approach makes sure you don't miss price action that could affect your trades, giving you a broader read on conditions before you enter. Before we get to the specific patterns every trader should know, let's understand the 2 main approaches that shape how they're interpreted: classic candlestick analysis and price action trading. Classic candlestick analysis comes from traditional Japanese charting. It focuses on the specific shape and structure of candles to identify reversals or continuations, using well-known patterns like the hammer, doji, and shooting star. These follow predefined visual rules and are usually read in the context of a prior trend. Price action, by contrast, is a more modern and flexible approach. Rather than relying strictly on a candle's form, it emphasizes market behavior at key levels: support, resistance, or supply and demand zones. Here, patterns like the pin bar are used to spot rejection and shifts in momentum. But their effectiveness depends heavily on where they appear, not just how they look. Both methods are valuable, and they often complement each other. The key takeaway: no candlestick pattern works in isolation. Context is everything. A candle's significance grows when it aligns with other elements of technical structure, making your analysis sharper and your decisions more confident. With that established, let's explore the most foundational patterns, ones that give real insight into reversals and continuations, and clear signals for entering or exiting. Let's start with a few patterns that are simple yet powerful, indispensable for any trader. First, the bullish pin bar, one of the most reliable reversal patterns in price action. It signals a reversal to the upside, especially after a strong downtrend or at key support. You'll recognize it by its small body near the top and a long lower wick, which represents rejection of lower prices. Now the psychology behind it. Early in the session, sellers are in control and drive price down. But as the session goes on, buyers step in aggressively, rejecting those lower prices and pushing the market back up toward the open or slightly above. That shift leaves a long wick below a small body, revealing that buyers are gaining strength, a clear sign of a potential bullish reversal. Now the bearish pin bar, essentially the opposite setup. It signals a possible reversal to the downside, particularly after a strong uptrend or near a resistance zone. And it has a small body near the bottom with a long upper wick that shows rejection of higher prices. As for the psychology, buyers start by pushing price up, but sellers then overpower that momentum, forcing a close near the open or lower. The long upper wick shows strong rejection of higher prices and a shift of control back to sellers. The longer the wick, the stronger the bearish signal, suggesting the uptrend may be weakening or ending. Let's explore the doji. It stands out because it doesn't give a clear directional bias on its own. Instead, it highlights indecision, where neither buyers nor sellers have full control. It often serves as a warning that a significant move, a breakout or a reversal, may be coming, depending on the surrounding price action. Let's look at the main types. First, the standard doji, where open and close are almost identical, leaving long wicks on both sides, a tug of war in which neither side gained dominance. Next, the gravestone doji, with a long upper wick and little to no lower wick. It forms when buyers push price higher during the session, only for sellers to pull it back near the open, often hinting at a bearish reversal, especially after an uptrend. Then there's the dragonfly doji, with a long lower wick and little to no upper wick. It appears when sellers drive price down, but buyers regain control and push it back near the open. This one is often seen as a bullish reversal signal, particularly after a downtrend. Finally, the long-legged doji, which as the name suggests, has long wicks on both sides, reflecting heightened indecision and volatility. Both buyers and sellers are active, but neither can hold control, and this doji is often seen before significant market breakouts. Now the psychology behind the doji. When one forms, the market opened and closed at nearly the same price, leaving a small body and long wicks on either side. This shows that while both buyers and sellers were active, neither could push price in their favor. The result is a standoff, often signaling that a breakout or reversal is imminent. The specific type of doji offers further clues about the market's next move. Now let's look at the hammer, a well-known bullish reversal signal that typically appears after a downtrend. It has a small body near the top and a long lower wick. That shape shows sellers first drove price down, but buyers later stepped in with strength, pushing it back up to close near the open. So, what's the psychology? At first, sellers dominate, continuing the downtrend. But then buyers enter aggressively, reject those lower prices, and spark a sharp recovery. The long lower wick represents that rejection, while the small body near the top shows buyers neutralize the bearish momentum. This shift points to growing buying pressure and a possible bullish reversal, especially when the hammer forms at key support or after an extended decline. Now the inverted hammer. Like the traditional hammer, it signals a potential reversal to the upside and usually forms after a downtrend. But its shape is different. It looks like an upside-down hammer with a small body at the bottom and a long upper wick. The psychology is slightly different, but just as important. Sellers start in control, but buyers make a strong push higher, enough to create that long upper wick. Even though price closes near the open, the bullish effort shows buyers fighting back and testing higher levels, which can signal a weakening downtrend and a possible reversal. However, because the inverted hammer closes near its low, it's a weaker reversal signal than the traditional hammer, and usually needs confirmation, a strong bullish candle on the next session, higher volume, or support at a key level. Next, the shooting star, a bearish reversal pattern that appears after an uptrend. It has a small body with a long upper wick. Buyers pushed price higher, but sellers rejected those levels and forced a close near the open. Psychologically, buyers control the start and push price up sharply, but by the end of the session, sellers overpower them and drive price back down, creating that long upper wick. This suggests the uptrend may be ending, with a downside reversal possibly to follow. Finally, let's examine the Marubozu, a powerful pattern that represents strong momentum. It's a candle with no wicks, or very minimal ones, meaning price opens at one extreme and closes at the other. A bullish Marubozu opens at the low and closes at the high, showing buyers were in control the entire session. A bearish Marubozu opens at the high and closes at the low, signaling strong selling with no resistance from buyers. Now the psychology. With the bullish Marubozu, the lack of wicks shows buyers dominated from open to close, with no pushback. That reflects strong bullish sentiment and can signal the continuation of an uptrend or the start of a bullish reversal. With the bearish Marubozu, sellers controlled the market from open to close, pushing price down with little to no resistance. That shows strong bearish momentum and can point to a continuing downtrend or a bearish reversal. The Marubozu is a clear sign of market strength, often used to confirm a trend or a strong directional move. In conclusion, reading basic candlestick patterns is a critical skill for any day trader. They reveal market sentiment and help you spot reversals or continuations. By recognizing formations like bullish and bearish pin bars, doji, hammer, and Marubozu, you can make more informed decisions